Alright, we've got 10 minutes because I got a plane to catch and I gotta leave this door in 13 minutes. So that'll give me 3 minutes to upload this sucker. You ready? Let's go. We gotta talk about the economy, recession, and real estate. All three of these in this video. Look, we already know some data. We already know that CPI has slowed and consumer price inflation has slowed to the lowest level in 2 years. We can all agree on that. We can agree that prices are still high, but we can also agree that in America, the Federal Reserve and the government doesn't care if prices are high. They just care if prices are rising rapidly, which they no longer are. They're still high though, so we're still stuck paying higher prices. We also know that wholesale prices have cooled more than ever before in the last 35 months. Yeah, that's 1 month shy of 3 years. I wish I could have said 3 years. And we also know we just had the biggest 1 week slide in treasuries since March of this year, when we had the banking crisis. And we just got banking earnings where we saw that consumers are still willing to spend and borrow, and results are way better than expected. So what could go wrong? Because at the same time as we're getting this data, recession expectations are actually being revised down. The Wall Street Journal just conducted a survey of, I didn't make the number up, 69 economists, and what did they find? That the same economists who thought in the prior two surveys that we had a 61% chance of a recession now believe that has been revised down to a 54% chance of recession, which initially made me a little bit concerned because we've seen this image before. Take a look on screen now. What do you see? Probability of the US in recession in the next 12 months. And if you look over here on the right, we could see this skyrocketing of recession to over 60%, and then we level out at 61%, and we just had a massive decline. Now, what makes me nervous is not that we had this basically guaranteed recession during COVID, but look at this. We've had this decline before. In 2008, between April and September of 2008, recession expectations actually fell. They fell from about the 70s to about 60% from April to September of 2008. And that made me wonder, oh my gosh, are we potentially just repeating the same mistakes? And we're thinking, oh, things are euphoric again, everything's safe. After all, consider the dot-com bubble. We had a 20% rebound of the S&P 500 from bottom up 20% 3 times before it was over. It took 14 years to recover your investment in some stocks, or just to break even. That's scary. So, is potentially this time different from 2008? Well, I guess the jury's probably still out on that. But what we can look at is the one thing that continues to give markets hope, and the one thing that's driving this expectation. It's jobs, which has a lot to do with real estate as well, which is why we're talking about all of this together. Look at jobs data. At the same time we saw recession expectations oddly fall in 2008, zoom in right over here to where the mouse is on the right. In fact, we can just pull this chart all the way to just 2008. Let's get that focus right on 2008, which is now over here in the middle. And what do you notice? You actually notice that jobs data was basically negative all of 2008. Yet really, inflation or recession expectations actually fell for the first nearly 2/3, the first 3 quarters of 2008. That's bizarre. It wasn't actually until jobs data started recovering that we really confirmed we were in a recession. This is, of course, because jobs data is an extremely lagging indicator, and we could absolutely go negative with jobs data by this October, November, and end up having a recession by the middle of next year. Problem is, most people seem convinced that if we have a recession, it's probably going to be relatively nominal. In fact, GDP expectations for 2024 are quite positive, probably because home builders are building like wild because there's a massive lack of inventory leading to a massive investment in residential fixed investments. That's a massive component of GDP, and people keep spending. GDP for Q3 of this year is expected to be 0.6% now, so we're not looking at a recession starting in Q3, especially since the prior expectation was a negative 0.3%. That's been revised way up, almost by an entire percentage point. Then, what do you have? You have 1% or a 0.1% to the negative expected for the fourth quarter. So you could end up getting a Q4, Q1 recession, but unless that's combined with a large lead of jobs loss, that recession's probably going to be super nominal. Recall, we were losing jobs for almost 9 months before we officially thought we were in a recession when Lehman Brothers collapsed in September of 2008. Remember, this gray bar that says you're in recession is decided like 2 years later. Like, we could be in a recession now without knowing it. But the data doesn't align with it now like it did in 2008. Who knows, maybe we're still at like a 2006, and that recession's actually more of a late 2004, 2005. Who knows? But what does it mean for real estate? Well, it means for real estate, people aren't anxious to sell their real estate, and they're still buying real estate. In fact, what we're going through right now is probably known as a HELOC boom. That is, people have jobs. They not only have jobs, but rather than sell and give up their 2.75 or 3.25% mortgage that's fixed for 30 years, they're taking out a home equity line of credit. Soon we're going to see the return of rental property lines of credit again, RELOCs, where you basically take out extra equity out of your home. And what does that let you do? Lets you go buy vacation, stocks, boats, cars, RVs, you name it. It just lets you keep spending as a consumer. Now, of course, all of this makes us scratch our heads and wonder, how is this not a massive debt bubble? And the reality is, it is. But that debt bubble doesn't have to explode now. Eventually it will. It could explode in 20 years, it could explode in 100 years, and our currency will eventually collapse at some point. It could be 1,000 years from now. But current data doesn't suggest it's now. Which brings me to my thoughts on real estate currently. Take a look at this. Most of us understand that real estate is inventory based, and inventory is massively low this year. Look at the 2023 level, or sorry, 2023 level of inventory. We're at 762,000 homes. Compare that to where we were in 2022. We had about 110,000 more homes on the market. 2021, we also had about 90,000 more homes on the market. Problem is, you started seeing an inventory trend up at this point, whereas now you're actually seeing an inventory trend down. Now, what's remarkable about this, though, is it's not just nominal inventory that matters. It's actually the month's supply of homes that matters. And this is pretty remarkable. Let me catch you up to speed. We already know, fact-based, most markets peaked between March and May of 2022. We hit a low in December of 2022 on prices, not necessarily sentiment or your opportunity to buy deals, but real estate has been recovering since January. So prices have already started trending back up. Some areas are already positive year over year with home price gains. But what's happening with inventory? Well, first, let me give you an example so you understand the concept. Very simple. If you're in a market where there are 100 homes on the market and 10 homes sell per month, how many months of supply do you have? Well, in this example, you have 10 months of supply. Okay? Well, what if we changed the data and said all of a sudden inventory fell to 50 homes? So inventory fell by 50%. And then you actually now only sold 2.5 homes on average per month. I know we're not selling a half home, okay? But on average, you're selling about 2.5 homes per month. Well, now all of a sudden, if you divide these two, what do you actually have? You have 20 months of supply of housing. So you could actually have less inventory, but also significantly less competition to buy those homes, giving you better opportunities to buy homes. And guess what that is actually showing up as? Well, we jump over here into the Redfin data center, month's supply. Take a look at this. Month's supply is starting to inflect up. Now, wait a minute, Kevin. Month's supply also inflected up in 2021 and 2022, right? Yes. But in 2021 and 2022, inventory was rising. So obviously month supply is going to go up if you have stable amounts of buyers and inventory is rising. But what you actually have here is inventory is falling, but month supply is going up. That means more buyers are leaving the market than houses are leaving the market, which actually means this winter could be a better time to buy real estate because you have more opportunities. This is what we're watching for our real estate startup, House Hack. We've been saying for over a year now we plan to buy in Q3, Q4. Hint, hint, we just started Q3. Probably September to December is going to be very juicy. We'll see. So I don't think there are going to be a lot of buyers. The people who need to sell are going to sell. And this might be the last moment we actually have really high interest rates. If 10-year treasuries peaked now and they slowly start trending down, we can maximize on big barriers to entry for buyers and therefore low buyers on the market, even in a low inventory market, actually have a better time to buy deals, better negotiating power. So how does all of this potentially break apart? Well, the one way all of this falls apart is if inflation expectations rise. That's the only way this breaks apart. People say, Kevin, the job layoffs are coming. I don't think so. I think most of the job layoffs and the repositioning already happened last year. And it's really just a giant rejiggering. A rejiggering is basically a way of saying, look, we overhired during the pandemic. Let's lay off a bunch of people. It's much easier to do that after after you have some economic turmoil. Because look, if you're Microsoft and you're like, look, I'm firing 10,000 people, that's really, really politically unpopular. And people are going to be like, why? And then Microsoft is like, well, your performance isn't that great. Okay, I'm suing you. That's bad. 10,000 lawsuits would be horrible. Obviously, 10,000 people wouldn't sue, but hey, if the economy is going into a recession, I mean, look at economist expectations. We're laying off 10,000 people because of the economy. Yeah, all right. They all get hired somewhere else. We have a rebalanced market. Those people go on to continue spending. So what is the one thing that can destroy the market at this moment? Well, obviously there's a black swan, but we aren't aware of a black swan. Otherwise, it wouldn't be called a black swan. It could be another banking crisis, some form of other collapse. I'd like to hear your comments on what kind of black swan there could be. We talk about this daily in the course member live streams, but you should be joining me in those. Make sure to join and use that coupon code before the 26th when we have a large expiration, so buckle up for that. But no, folks, it's actually the following. It's 5-year break-even inflation rates. You already know this. You already know that as long as this number continues to stay stable, the Fed can be relatively patient. The fact that it started trending up a little bit on the right is why we got another 25 basis point hike. And I believe that once this gets down to about 1.6, the Federal Reserve is going to cut. I think it's very simple. But if we get another runaway like we did over here in January or February, expect rates to go to 6 to 6.5%. That's what's going to hurt the market. But otherwise, this is a market that I find very difficult to short. I find very difficult arguments to say it is not the time to look for opportunities in undervalued stocks and potentially undervalued real estate if you can get your hands on some sick deals. Stay tuned. I should be able to fundraise for my real estate startup within the next 30 to 45 days. We are so close. I'm just waiting for that SEC approval now. And folks, thank you so much for watching this video. I hope you check out the courses on building your wealth link down below. And we'll see you in the next one. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced